Hello, everyone, and welcome to Numera Analytics webinar focusing on U.S. asset allocation strategies, as well as a discussion on our U.S. equity high conviction calls. Today is definitely a big day in the markets, as the Fed will be rendering its decision on interest rates. Markets are firmly pricing in a rate increase of 25 basis points, but what is not clear is where they go from here. Are we entering a standard rate cut cycle as growth comes to a standstill? Or is sticky inflation going to handcuff the Fed and force them to keep rates higher for longer? Are market expectations properly pricing in inflation and growth? Helping us today to navigate through these difficult questions are Numera economist Mathieu Weiner and Joaquin Chris Lara, our chief economist and strategist. But before handing it off to you guys, if you have any questions during the presentation, please use the message feature on your screen and we will try to get to them during the Q&A at the end of the call. After the presentation is over, we'll make sure to send you the slide deck by email. And now Mathieu will start by discussing our US allocation strategies. Mathieu?
Yes, thanks Chris, and thank you to everyone who's joining us here for our online briefing today. So before we dive into our asset allocation recommendations, we think that it's really important to understand what has been driving recent market developments. And so our starting point today is going to be to try to determine why and how the S&P has rallied so strongly so far in 2023, despite slowing growth and despite turmoil in the banking sector. So the chart that you see here is the result of a structural modeling exercise which assesses the relative contribution of various macro factors onto S&P market returns. Now, as you can see, the S&P is up 8.1% in real terms year to date, despite slowing growth, which is shown here in the yellow bar, and hawkish Fed policy, which is shown here in red. Both of these factors are actually standing as important headwinds in the current environment. And so the main factors that are actually behind the year-to-date rally are lower financial stress and improving sentiment. So financial stress metrics are actually currently lower than they were late last year, despite the collapse of 3 mid-sized banks in the US this year. So markets are pricing in lower financial strain this year. This is the result of the fact that the Fed and the Treasury rapidly intervened following the collapse of Silicon Valley Bank and Signature Bank in mid-March. This prevented financial contagion, and in addition, there's also been a fall in long-term Treasury yields, and alongside a drop in investor inflation expectations, these have all contributed to a reduction in financial strain metrics so far this year. And so these developments help explain why investor sentiment has rebounded quite significantly so far this year. There are several metrics like falling put-call ratios and rising bull-bear spreads that confirm this, but really rising sentiment largely reflects positive economic surprises in the form of rapidly slowing inflation and resilient consumer spending growth figures. Now, at the same time, perhaps the most surprising feature of this rally is the fact that it's exceptionally concentrated within a handful of mega cap companies. That's what we're illustrating in this chart, where what we're doing is comparing cumulative returns since 2021 for the top 5 companies in the index by market capitalization, and we're comparing this to the remaining 495 companies in the S&P 500. So as you can see, there's a very large gap that has opened up in 2023 between these mega caps, which are up 36%, and the rest of the index, which has risen only 1.5%. A lot of the recent returns in mega caps, we think, is explained by falling yields, lifting valuations, but also by investors intentionally flowing into these companies, which they see as highly diversified in their revenue streams, and thus perhaps less exposed to slower growth than small caps. And as a result, this highly uneven rally leads us to believe that the market is really underestimating, or at the very least mispricing growth risks. So as I mentioned earlier, lower financial stress metrics are one of the key reasons behind the current rally. And it's really clear to us that financial stress on the ground is far greater than what markets are discounting right now. So this chart that we're showing you here illustrates this quite clearly, and it compares real credit growth year over year in the corporate and industrial space, which is shown here in gray, to a diffusion index that quantifies the extent to which commercial banks are tightening their lending standards to corporations. So this metric comes from the Federal Reserve Board's first quarter senior loan officer survey, which points, in very clear terms to a sharp contraction in corporate lending over the coming year, as lenders report lower demand for credit and rising liquidity concerns as well. So for these reasons, we think that financial conditions are quite a bit tighter than what market-based metrics are currently accounting for. And to us, the main implication of market underestimating financial strain and overestimating growth is due to the fact that profitability will very likely weaken this coming year. So Q1 earnings season has so far been quite favorable, but our models suggest that an earnings recession is actually the most likely outcome over the coming 12 months. So as you can see from the probability distribution shown here, we think that the most likely outcome, our baseline scenario, is for earnings to fall 1.7% after adjusting for inflation 1 year out. Also, what you should notice here is that there's only really a 1 in 4 chance of earnings growth exceeding the trend pace that we've seen in recent years, but also that tail risk on the left here is very, very significant, and that earnings could plausibly fall close to 30% in a very adverse macro scenario. But the key point here is that we're quite likely to see negative earnings surprises in the S&P in coming quarters. So while equities will likely not benefit from positive developments on the earnings front, we do think that valuations could provide some support to returns over the coming year. And to be clear, we do expect the Fed to begin lowering rates in Q4 of this year, but we also think that the easing cycle will be very, very gradual. So for this chart, what we're comparing is our outlook for the Fed funds rate starting in Q4 of this year. This is shown here in blue. And we're comparing this to how the Fed has historically responded to stagflation in green, and to typical deep recessions like 2008 or 2002 in red. And as you can see, our forecast for the Fed's easing cycle is essentially sort of an in-between scenario. So while we do think there will be some support for multiples expansions next year, we really don't see valuations driving returns as much as they did in 2020, for instance. And so while we don't see lower interest rates really resulting in a great outlook for overall equities, we think it more so improves the relative appeal of fixed income investments. So in this chart, what we're showing you is how our latest forecast for long-term yields, the red line here, has changed fairly significantly since the start of the year, as indicated by our January forecast, which we're displaying here in yellow. So our more optimistic, if you will, forecast for the 10-year Treasury yield is the result of a growth picture that has weakened in recent months, and an outlook whose risks skew decisively to the downside. And as a result of this, our models show that this significantly increases the upside for fixed income investments moving forward, but really for high quality government debt in particular. So as Joaquin will explain in further detail in a few minutes, we do think that corporate and high yield bonds and bonds in certain sectors are significantly less appealing because of the fact that markets are not correctly pricing in credit default or liquidity risks in the current juncture. Now this brings us to the punchline of our asset allocation recommendations. So this chart here compares the typical asset allocation of a mutual fund. This is on the right hand side of your screen, and where a typical mutual fund will typically have 60% of its assets in equities and the remainder in fixed income. And we're comparing this to essentially the result of Numera's optimal portfolio weights at different time horizons. So what you can see is that in the short term, over the next 6 months, we think that stocks could continue to benefit from low perceived financial stress and the momentum that's provided by currently improving investor sentiment. But at longer horizons, it becomes very clear to us, and we advise clients to gradually shift their portfolios towards fixed income positions in order to shield themselves from a macro picture that will likely be quite worse than what the consensus is currently expecting. Now, with that being said, we believe that nonetheless, there are still interesting opportunities in the equity space. And I'll now hand you over to Joaquin, who will go over specific plays which we think could help you generate alpha in this challenging environment.
Thank you, Mathieu. That's exactly right. We've been, from a broad macro standpoint, we are now leaning more conservative. This hasn't always been the case, but certainly our research and our models signal a much better risk-reward balance for high quality debt than it does for equities. But it doesn't mean that there aren't opportunities within the equity space. As I'll discuss, the risk-reward profile varies considerably across sectors, and in particular, even across subsectors, opening up the opportunity for fairly significant alpha generation, which I think becomes important in an adverse equity environment. And so what I'll do over the next 15 minutes or so is go through basically a selection of our top conviction calls that we're sort of now recommended to clients. This is something that is obviously a key part of our offering, where above and beyond the macro research that we do, a lot of our clients are obviously interested in actionable ideas, and so that's something that we try and push continuously. And so what I'll be doing essentially is guiding you through some of the top conviction calls that we sort of push and address on a regular basis. For more detail, every Monday, for those of you that are subscribers or on trial, you do get sort of a more detailed update of all of our top conviction calls, not just for the US, but also for global asset classes as well. But again, the idea today is just to go through 5 or 6 opportunities that we think are particularly important in the current context. So I think when thinking about sector rotation, it helps. The starting point is just to understand sort of what's been driving the relative performance across various sectors. And really in the last year and a half, it's been essentially all about Fed policy. For example, what the chart that you see in front of you here compares is the relative performance of consumer discretionary and consumer staple stocks in the S&P 500 against long-term real interest rates, which are fundamentally affected by expectations around future Fed policy. The real rate series is inverted just for you to see the relationship more clearly. But basically what we've seen is, a continuous increase in real yields as markets kept underestimating the speed at which the Fed hiked rates. And that essentially compressed valuations for all equity sectors, but in particular, growth stocks and highly cyclical stocks, which are more sensitive to changes in interest rates. And so that's essentially favored since, particularly since the start of the Fed hiking cycle in the first quarter of last year, it has favored segments that have a lower exposure to interest rate hikes. What hasn't really been at play yet, and we do see this happening increasingly, is the role of economic growth in driving sector rotation. As Mathieu was saying, we think that the market is heavily underestimating the likelihood of a significant slowdown or contraction in economic activity, both stemming from weaker household spending, weaker investment and industrial activity, and weaker construction. And that has deep-rooted implications on sort of at the highest end on style positioning. I think this chart is quite important to go through. What this shows you is a comparison in the relative performance between defensive and cyclical stocks in the S&P 500. That would be the gray line. Remember, defensives are those sectors that typically outperform during economic downturns. That would include things like staples, healthcare, utilities are part of defensives. Cyclicals include discretionary stocks, industrials, financials, and basically sectors of the economy that are very sensitive to the economic cycle. Now, historically, as you can see here, the relative performance of these two things fundamentally depend on spending ratio. So basically, how much are US consumers, which are 70% of the economy, spending on necessities relative to discretionary items? That's the green line. In recessions, the spending ratio tilts towards defensives, that would be the green line, and we've yet to see that happen. Consumers are still overwhelmingly favoring spending on discretionary items, even durable goods that are usually interest sensitive, but they still continue to buy vast amounts of discretionary items, partly because they're burning through, excess savings that were built throughout the pandemic, and also because job creation is really strong, and so expectations of future joblessness are contained. As economic activity deteriorates and you get these negative earnings surprises, you would expect the expenditure shift to shift in favor of necessities, and that would make a fairly strong case for defensives relative to cyclicals in general. Now, that said, there are big differences between both of these subsegments. Within the defensive space, arguably the sector that we like the most is healthcare, and in particular, healthcare services. Now, much like is the case for defensives overall, the relative performance of healthcare versus the overall market is very much linked to the expenditure share on the ground. So the green line here shows you, it tracks the evolution of health stocks relative to the S&P 500, that's in green. And then the red line is the household spending share on healthcare services. So this would include hospitals as well as outpatient services. More than virtually any other sector of the economy, spending on healthcare is still very, very weak relative to its pre-pandemic trend. And the reason for this is that healthcare is essentially a contact service. As economic activity deteriorates, this is a sector that would likely benefit from a normalization in mobility as public health risks have diminished. And so the upside is much greater than for other defensive categories like food, for example, or personal care products that are not contact services like healthcare are. There are also mobility valuation aspects that one can consider here. Healthcare is trading at more attractive valuations than other types of defensives, and so this again improves its risk-reward profile relative to defensives at large. Within the cyclical space, we also see very, very big differences across sectors. I would say that the most important split here is between tech and non-tech. So tech would be, you can think of it as growth cyclical stocks, and then non-tech would be value cyclical stocks. So things that really depend on conditions on the ground. The fact that we think that yields will fall make sectors that are more sensitive to multiples expansion more attractive than those that depend more on economic activity. And so in general, that would make tech a little more attractive, certainly, than things like deep cyclicals. Within tech, though, there are also sort of varying, the risk reward profile can vary. For example, what you see here is a comparison in the relative performance of hardware and software stocks within the IT space. Remember, these are the two biggest sectors within IT, the other one being semiconductors. And then the red line shows you the evolution of relative prices in these two sectors. So basically, the price of computers and smartphones, for example, relative to the price of software services. Since the start of the pandemic, hardware has been a massive beneficiary. Obviously, it was hit by rising interest rates last year, but on a trend basis, it has benefited from, increased demand for from work from home gear, for example. That was really, really beneficial. And then there was also excess demand for hardware, which allowed them to producers to keep high profit markups. So inflation in that space was very high, supporting earnings. Moving forward, a lot of these trends will likely reverse. Hardware is very exposed to a goods recession, which is where we think a lot of the weakness in the economy will come from in the next 12 to 18 months. And conversely, software stands to benefit much more from secular demand trends, like a shift towards cloud computing, right? So even as economic activity stalls, growth in cloud computing, growth in AI will make software more resilient to an economic downturn. And then the other important thing is that software is considerably more sensitive to falling yields than hardware. Based on our simulation exercises, a 50 basis point drop in 10-year yields translates into expected gains on software of about 4% versus 2% for hardware, right? And so if you're in a situation where long-term yields start falling, that would make software more appealing. You can make a similar argument with e-commerce now reclassified as broadline retail by the S&P. Value cyclicals are a completely different story. Here, there are two major sets of risks in our view. The first one has to do with the fact that the manufacturing sector and heavy industry is very much at risk. The way we quantified this is we got our economists to conduct these simulation exercises to understand how much of the drag from rising interest rates was already passed on or had already materialized when it came to physical production of manufactured goods. And this is what this chart here shows you. What the red dots show you is how much have industrial production already adjusted based on interest rate hikes. Remember, so far the Fed has raised rates by about 450 basis points. We estimate that a 450 point hike in interest rates could lower industrial production by about 5%. And yet industrial activity overall has declined by less than half so far. And so what that tells you is that there's still a lot of downside to be had, especially in interest sensitive segments like consumer durables, where the expected decline in production could be as much as 8%, and you've had much less sizable declines. And so within the S&P space, industrials are obviously the sector or the category that's most at risk here. And so while we think that, again, the balance between upside and downside risk for industrials is not particularly favorable, it helps to sort of drill deeper into these segments. Remember, industrials is comprised by like 8 subsectors or something that have reasonably large market caps and you know are quite traded by investors. To illustrate the sort of the varying appeal of different subsectors, we typically do this with charts like the one you're seeing in front of you here. What this chart compares is the upside against the downside risk on 12-month investments in S&P Industrials and its subcomponents. Remember, if you do read our research, we always defined upside risk as the probability of you making money of an investment times the expected gain, or how much money could you realistically make on that investment. Conversely, downside risk is the probability of you losing money by the expected loss in that investment. And so if you have high upside and low downside, then obviously that's more of an attractive investment, especially if you're a long-only investor. And so the numbers in red basically rank these sort of various subsectors by their risk-reward profile. You'll notice that in general, industrials are less attractive than the S&P overall, basically because they typically have higher downside. So for example, if you compare the S&P against machinery, upside risk is similar to the broad equity index, but downside risk is much greater. The same thing holds for capital goods. But even there, we do see some, you know, significant differences and opportunities. Things like machinery, building products, these are very exposed to a contraction in goods demand and falling investment. There's other sectors though, road and rail, for example. Road and rail, clearly that's a cyclical sector, but in downturns, it behaves more like a defensive because it has very significant market power. The other thing favoring road and rail, if you do get a downturn, is that it basically relies on domestic revenues, or like the vast majority of the revenue stream stems from domestic revenues. And so they're not affected from dollar appreciation nearly as much as other segments. And so that's something that we do expect will happen as financial stress spikes, and that would make something like road and rail a lot more attractive than machinery, aerospace, building products, and so on. Airlines, that's another one we like. That's obviously within industrials, that's a classic cyclical sector. Airlines have done really poorly since the start of the pandemic. They're down 40% in relative terms against the broad S&P. As, again, airlines are a contact service, right? And so as international travel resumes, not only does that improve generally the revenue stream of airline companies, but it also makes it more likely for airline tickets to rise, particularly relative to variable costs like jet fuel, right? So if global demand conditions weaken, oil prices will likely fall or adjust downwards. And so that would improve the profit margin of airlines, which, as you can see here, is by far the biggest determinant of returns for that sector relative to the S&P. So that's another one where, again, it's a cyclical, but it's one that has fairly sizable alpha opportunities. The other classic value cyclical sector are consumer discretionary stocks. Consumer discretionary has been doing fairly well so far this year, and a lot of that has to do with positive earnings surprises. As Mathieu was saying, consumption has surprised on the upside. It remains quite resilient, aided by strong job creation and consumers burning through post-pandemic savings. Excuse me. We basically expect this to reverse. Certainly, professional forecasters are not considering the possibility of a fairly sizable slowdown in consumer spending. What this chart here illustrates is our probability forecast for real household spending growth in 2023, that would be the distribution in blue, and for 2024, that would be the one in green. The key thing I want you to focus on here is the shaded blue area. The market currently is expecting private consumption to grow 1.5% this year, basically providing all of the support to growth at large. That's not impossible, but we identify a 1 in 10 chance of that happening. And we think this is the case because we see unemployment already bottoming out. Survey measures like hiring needs and that sort of thing are starting to decline, and that points to basically weakening consumer spending, especially for highly discretionary categories. And so this would make earnings growth in consumer discretionary sectors very vulnerable to negative earnings surprises in the second half of this year and in 2024. Again, like industrials, the risk-reward profile varies between subsectors. The sectors that we like the least are those that are very interest sensitive. What you see here is a comparison between the spending share or consumption share between goods and services by households. That's in red. Goods really rose sharply after COVID, and they still remain very strong relative to spending on services. And then the blue line shows you the evolution of 10-year real yields, but inverted. 10-year yields typically tend to lead that sort of expenditure ratio by about 9 months. And so the fact that they're already very high would suggest a significant shift in expenditure away from goods and back towards services, which would certainly benefit, for example, consumer services, against, say, brick and mortar retail, which is actually a call that we've had open since the fourth quarter and one of the ones that has done already really, really well. And then just to finalize on consumer stocks, and I'm close to finishing here, there is one sector that is fairly small within the consumer discretionary space, but one that has a lot of interest on investors, and that's home building. Home building is fairly small in terms of market cap, but it has a couple of very, very big ETFs, right? So the size of the ETFs in terms of AUM are much larger than the size of the sector itself, again, because it's sort of the easiest way to play the housing cycle, essentially. Now, typically, home building stocks would be very interest sensitive. So historically, as you can see here, their relative performance is very much tied to changes in real interest rates. When real interest rates rise, home building stocks typically do worse than the market as a whole. In the last 6 or 7 months, a massive gap has emerged, with home building stocks rallying very sharply. They're up 60% since the start of the fourth quarter, which is more than 3 times the S&P overall, even in a context of high real interest rates. And to us, this essentially reflects optimism on a soft landing, right, which would prevent widespread mortgage defaults and probably contains persistent declines in residential housing prices. Now, this is the largest gap that has ever emerged, at least since we have history on these indices. But if you notice from these charts, there have been gaps in the past. So in 2013, 2015, and 2017, home building did really well versus the market relative to what macro fundamentals would have suggested. When the gap was even as half as it is today, on average, home building underperformed by close to 20% against the market 12 months into the future. And so in a context in which housing supply is starting to rise and housing affordability remains really weak, that makes short positions on home building really attractive. We see, for example, real housing prices falling at least another 10% from the peak as the market balance deteriorates, days of supply rise. And you can see a fairly persistent drop. We're not talking 2008, 2007, 2008 type corrections, in part because you have much lower exposure to very risky borrowers. But we do see a fairly persistent correction that would obviously hit residential construction companies. And then I'll leave you with this final idea. More than the residential investment space, where we're quite concerned and we do see interesting opportunities for shorting, is commercial real estate. Commercial real estate, the prices of commercial real estate have already declined, but solvency is not really a risk for REITs and property developers so far, basically because most CRE loans and leases have yet to expire. As they do, then basically property developers will be simultaneously faced with higher interest payments, so that's going to make refinancing costs more expensive, and they'll also likely encounter difficulties with regards to rental income, because especially in the office space, but even retail and industrial REITs are probably exposed to a slowdown in industrial activity. And so in that context, we see demand for commercial real estate falling. The two ways in which we're suggesting you can play this would be through either shorting REIT ETFs. There's a couple of those available. The other possibility is through commercial-backed securities. Spreads on commercial mortgage-backed securities, or CMBS, they have risen relative to corporate spreads, but nowhere near as much as they do in past recessions. And again, as default risks start rising, when refinancing of loans and leases increases, then we do see spreads widening considerably. The other thing we're asked often is, what does this mean for regional banks? Because regional banks, 30% of their asset base are commercial real estate loans. Yes, obviously they're very exposed, but valuations are already very low relative to the market. And so it's less of an attractive play than going after REITs directly or even shorting commercial MBS. So with that, hopefully that gives you a good sense of, at least a summary of where we see the market heading overall and some of the opportunities that we see within the equity sector space. If you do have more interest in any one of these particular calls, do reach out. We have research and reports written for all of these. And so, if you did want to drill in more detail as to what our thoughts are on specifics, both on the asset allocation or the equity sector side, do reach out and we'll be more than happy to share the research with you.
Thank you, Joaquin. So we do have a few questions in the queue, and I'll start with the first one. Your U.S. optimal portfolio weights are implying to take on a more conservative stance 24 months out compared to 6 to 12 months. Can you elaborate on this?
Yeah, so that's, I think Mathieu alluded to that at the end of his section. We think a lot of that has to do with momentum and sentiment. Financial stress metrics, market-based financial stress metrics are still low, and investor sentiment remains bullish. And so it's very likely that investors will continue to pile up at least on mega cap stocks within the next 6 months, because it's also going to take time for the economy to really deteriorate, right? It takes about 12 to 18 months for rising interest rates to really hit the economy. We're now only starting to get to a point where monetary policy is really contractionary relative to sort of equilibrium interest rates. And so it will still take some time for consumption and for investment to really weaken. And so from a tactical standpoint, there is a case to be made of remaining, fairly bullish in terms of near-term equity bets. But for mutual funds in particular that tend to plan a quarter, 6 months, or 12 months in advance, and have maybe less flexibility in terms of their allocation mix, we do think that adding up high quality debt gradually would make sense. Also, for example, the differential between earnings yields on the S&P and the yield on high quality debt is really, really narrow right now, right? And so it is a good opportunity to increasingly add exposure to something that will likely do increasingly well as long-term yields start declining.
Thank you. Just a follow-up to that. Does that mean equities go down 24 months out?
Yes. So earnings, yes, for sure. I think a lot of it will have to do with how much valuations can offset the earnings decline. We see a very, very high probability of a persistent correction in earnings. The valuation call is a little more uncertain. Right now, if yields were to fall very sharply, you could get some support from valuations and look at something like flat returns, let's say, if you focus 2 years out. But flat returns with 3 to 4 times the tail risk on equities relative to debt is not an attractive bet.
Okay, thank you. Question number 2, how does a scenario with persistent high inflation, close to 4%, change your equity view? How likely do you think this is?
Right. So right now, say our view on Fed policy and our view on long-term yields assumes, or it's implicit in that is a gradual normalization in inflationary pressures towards close to the Fed's range. The thing is, that's just the baseline scenario. There's like a 75% chance that inflation falls below 3% next year, but that's just the most likely outcome. If you focus on the right tail of the distribution, which is what you really care about when you think about inflation, you can't discard a situation of, say, 5% inflation, 4 or 5% inflation for a persistent period. For that to happen, you would basically have to have really sticky service inflation, which would have to depend on long-term inflation expectations remaining elevated and wage pressures remaining elevated. The likelihood of that happening is not that high, but it's not something that we can discard. Break-even inflation, which is market expectations around inflation, those are basically back at targets. The 5-year break-even, I think, is at 2.2, which is essentially target. But say 1 year ahead, consumer inflation expectations are still about 4.5%. And so for sticky segments of the economy, then that means that it creates inflation persistence. Similar, you can make an argument that labor supply, as long as it remains constrained, that would mean that job market conditions would remain tighter than otherwise. Even as job creation stalls, translating into persistently high nominal wage growth, maybe not at the 6% that it is right now, but say at 4%. And so that would mean higher trend inflation, even as activity deteriorates. Again, not the most likely outcome, but a situation in which, but something certainly that you cannot, that you shouldn't discard. If you were to transition towards that scenario, say a 4% persistent inflation scenario, then that basically what that means is that instead of you getting a classic recession, you get stagflation. And if you get stagflation, that's really, really bad for both stocks and bonds. For bonds, what it means is that instead of you having a correction in yields from, say, 3.5 to 2.5, you could have easily yields at 4, right? Because you have these positive inflation surprises pushing up break-even inflation and forcing the Fed to maintain a hawkish stance for longer. For equities, what it means is, compression in valuations for a persistent period, and the fact that as Fed policy remains tight for long, the earnings outlook would deteriorate further. It doesn't necessarily mean that you should position yourself very differently from what we're saying, just that the overall outlook for portfolio construction, for the stock bond mix, regardless of what the weightings are, would just be worse, right? It would just be both worse for bonds and worse for stocks. And so there you really do start to get more creative. You need to look at things like gold, emerging market assets, things that are not as sensitive to stagflation, to US-based stagflation. So you would need a lot more diversification, both in terms of the asset mix itself and the geographical mix as well.
Well, thank you very much, gentlemen. And thank you everyone for listening in. If you've got any additional questions, just reach out to us. We look forward to having you in a month's time during our next webinar, and have a great day.